So, in today's cheeky trading, before I start to talk about patterns, I actually want to talk about two different types of investment or trading styles. The first one being the momentum trading style and the second one being the contrarian trading style. After explaining these two different types of trading styles, I actually want to talk about patterns, more specifically about triangles. I want to explain the difference between bearish triangles and bullish triangles, and also how you can actually use technical analysis to find them in the charts and how you can actually trade with them. So if you're curious about it, just chill and keep watching. Hello everyone, how's it going? Welcome back to my channel, and this is your host, the Cheeky Entrepreneur. So as I mentioned, before I start talking about patterns and about triangles specifically, I would like to talk about these two investment or trading styles. So the first trading style is what is called momentum trading, and this is basically this herd behavior when you're going to the upside or when the price is actually going to the downside. And for instance, you can really notice this in bull runs or in bear markets. So for instance, if we actually go to the Bitcoin chart, you can really appreciate both of them. Before 2017 and 2018, we had this bull run or bull market. Whenever you see that the price actually retrace, the price would continue going up, it would retrace, and it would actually go up. So this is what we call this herd behavior, and it's basically just an increasing buying or selling volume to one side. And the opposite here, you can see in the bear market, after that bull market we actually retrace and we continue going downwards, and every time the price actually bounce up, it would have been a good idea to actually short the price, and the reason is because you are in a macroeconomic bear trend. So even though sometimes trends seem that are unbeatable and are never gonna end, in reality they always find a reversal point for at least some time, or maybe for a longer periods of time. And trading these reversal points is basically what it's called the contrarian or reversal trading style. So basically what you will look is for exhaustion points in a trend. It doesn't matter if it's a bull trend or if it's a bear trend. For instance, here you would actually look at the price, and after looking that this went high that excessively, you would look for potential exhaustion points in order to actually trade to the other side and trade to the downside in this case. Or for instance, in right now in Bitcoin, you would actually take a look at possible exhaustion points for the bears and would actually try to trade to the upside. And this particular trading style yields a lot of profit, and the reason is because you are going against the herd. You are basically the contrarian, or the one who takes what the least amount of people is taking. And even though this can yield a lot of profit, you have to take into consideration that this can carry a lot of risks. Therefore, it's very important that you combine these two trading styles, because the best thing that you can do is actually profit from the momentum, profit in the bigger macroeconomic picture from a trend either to the upside or to the downside, and actually trade against when you start seeing these exhaustion points. And for instance, here you can see in Bitcoin, you could have profited from the bull run. Then you could have noticed that there were some exhaustion points around the 19,000 level, and you could have started to short and trade to the other side. A very good example of this is the financial crisis of 2008 and 2009, where we actually had a bull run in the first part, but then you can actually see that there were some exhaustion points and there were some problems that were being generated. And if you would have actually taken that to the downside, you would have profited. And the same goes after the crisis, because a lot of people actually started buying the stock when everything dumped and just crashed. That's where a lot of people, big institutions, put their money, because they believe that that's actually gonna turn around. So now that I have talked about these different styles of trading, I actually want to start talking about patterns, more specifically, as I told you, about triangles. And for instance, I have created this kind of matrix to really explain you the different kind of triangles, because we have bullish triangles and we also have bearish triangles. And here you would normally find in these investment styles that you can find continuation patterns or contrarian / reversal patterns. Of course, this does not mean that in every single scenario you will find it. Sometimes you might have a continuation pattern in a reversal, and that might actually mean something. So you really have to take into context whatever is happening with the price action. So I just want to start with the first triangle, and this is what is called an ascending triangle, as you can see in the top to the left. And this is basically characterized when the price actually goes and meets certain resistance, go back down, but the bulls are actually pushing the price forward. Then you meet again that resistance, go back down, but again there's more pressure, and finally the price breaks up to the upside. And this is usually a continuation pattern, although you can also find that whenever you have a bear trend, you can start forming this pattern to the upside. Similar to the ascending triangle, you have the descending triangle, which is basically the same, just to the downside. You have a price pushing downwards, meeting some support in there, the price actually getting more momentum to the downside, coming down, you meet more support, then coming up, and then the pressure keeps going on until you break to the downside. So what's basically in the middle of these two is what it's called an asymmetrical triangle, and the reason is because you can come from the upside or you can come from the downside, but the fact is that you're gonna see that the price actually falls into this kind of triangle, and it's actually gonna decrease in volatility, and you will usually find that the volume is gonna be decreasing. And the reason is because after this decreasing, you will most likely find out that the price actually explodes to either the upside or to the downside. So you can have a reversal pattern that's neutral, or you can also have the other way around, establishing this triangle and actually continuing to the same side. So you have to take this into consideration when meeting asymmetrical triangles. So the last two triangles I want to talk about are really called wedges. So you have in the green side here, you have what's called a descending wedge, which is a bullish sign, and on the right side you have the rising wedge, which is basically bearish. And I'm including them into this category of triangles because you can see what the price is actually doing. And these most of the times are kind of reversal patterns, but again you can use them for continuation patterns as well. And what's important about this price is, for instance, if you have the price actually going down, you would find out that the momentum is running over, so it's not actually going any lower. But the point in here is that you will find out that the inclination, you have a certain inclination. So for instance, the difference in here to a normal triangle or to a descending or ascending triangle is that one of the lines is not gonna be horizontal, it's not gonna be perfect resistance or a perfect support, and therefore you have kind of like this angle in here. So that's what gonna give you this notion of saying, okay, this is actually a rising or descending wedge instead of ascending or descending triangle. And for instance, what you will find, if in the case it's a bullish scenario and it's a descending wedge, you will find out that the price is gonna converge in a certain way, and then it's actually gonna go to the upside. And again, in the opposite manner, you might find that the price actually goes up, it's gonna start converging, you're gonna lose momentum, and this is a sign of exhaustion, so you will see that the price is actually gonna fall to the downside. So now that I've explained you how these triangles work theoretically, I would like to find some examples so that you can see how you can actually find them and how you can actually potentially trade them. So one perfect example is this descending triangle that we obtained after the bull market in Bitcoin, and as you can see, it's pretty noticeable that you are having lower highs around here. So you would actually compute that line and you find out that you have more or less a resistance around the 6K level. So this is basically what is called a descending triangle, and as I told you, you can actually have that as a continuation pattern, or you might have that as a reversal pattern. In this case, it's a continuation pattern from the movement to the downside. Here you can see the price actually started bouncing from this resistance, or from the support at 6k, went up, went back down, find again support, went back up, but the pressure to the downside kept going on, thus the price actually compresses, and then you have a sudden break to the downside. So most of the time you will find out that these patterns are actually true if they develop and they get a confirmation of breakout. But for instance, this will actually help you because you can notice them from before and then you can keep your eye on them. For instance, here we have exactly the opposite. We have a potential ascending triangle, and for instance we have a low over here, then we have a higher low, and we could potentially say that this is actually gonna keep going up. So in that case you can compute a triangle similar to this and you find out that you have some resistance around here and around here, so you would compute that triangle in this manner. And what you can expect from the price is that it's actually gonna bounce up from this resistance point. It's gonna get more pressure from the upside, gonna actually go up, meet resistance again, and it's probably gonna be doing something similar to that until the pressure is enough and it actually breaks to the upside. And again, this not only means that if you find these patterns, they will always break to the side that I'm telling you. For instance, an ascending triangle can always go to the other side. It can actually break to the downside, but the amount of times that happens is gonna be less, and as usual you will have to combine all of these with risk management and correct money management in order to actually take advantage of these patterns. So after explaining those first two triangles, here is one example of a potential neutral triangle or asymmetrical triangle around here. If you don't see it, it might not be obvious until you actually have traded a lot, have done a lot of analysis, then it will be coming more and more normal. But here you can notice that you have kind of a resistance forming in this way, and then you also have the similar thing going from the downside. And as you see, there is not a clear bias or where the price is actually going, because you have a downtrend in here, but you also have an uptrend from the other side, and that's what characterizes this neutral or asymmetrical triangle. And here you can have it as a continuation pattern. For instance, here it was kind of that you were going to the upside, then you met this pattern and you actually break to the upside, so that's a continuation pattern. But it could also be a reversal pattern. So for instance, in this case, there is no reason why this wouldn't have broken to the downside. And this is very important because if you want to trade this, a good way to trade is trading the breakout. So for instance, out the line you might put a pending stop order, which basically means that if the price actually goes up this level, you would actually enter the market with a long, and you will actually get benefited from the momentum trade to the upside. And you can also do the same to the downside. And I would recommend you always have a stop loss in both scenarios. So for instance, if you trade to the upside, maybe you want to have your stop loss at the other side of the triangle in order to diminish any losses that you might have if the price doesn't go your way. So just to finish, I want to highlight some examples for wedges. In this case, we actually have two descending wedges, and you could have seen it from before. The first one is in here. You actually have a line to the downside around here. You can always adjust it to where the price is actually going, but again, something that I told you is that you won't find this horizontal resistance. So for instance, here you can see that we have various points of resistance. For instance, one around here and the second one around here. So that's what characterizes a wedge, in this case a descending wedge, because the price is actually going lower every time. But here as well you see the breakout, and the way to trade this is putting a pending order around here, or if you feel more confident, potentially take a trade when it's touching the lower part of the descending wedge and then waiting for it to break to the upside. In any case, you should have a stop loss, and then you can just profit from the movement or from the swing to the upside. And if we continue in the same chart, you can actually appreciate that the price is actually doing something similar, and I mentioned this in the Discord channel in some of the trade setups that I've had. that you would find something like this. Again, you don't have a horizontal resistance around here, so it's not either a descending or ascending triangle, but because you have this decreasing price, and you find that the price actually fluctuates between these two lines and the volume usually tends to go down, you will find out that this actually breaks to the upside. Well, in any case guys, I hope that you will learn something. Patterns are not everything in technical analysis. You have to take into consideration what I've taught you before about indicators and put everything into context. I'm actually gonna be doing another video on other patterns, and then I'm gonna try to put everything together and create a video where I actually show you what my trading style is, taking in consideration all these indicators and actually arriving at potential trade setups. But in any case guys, I hope that you enjoyed the video, and if you did, and only if you did, mind subscribing and also like the video. By now you should know that I'm also active in other social media. I got an Instagram account where I put all the highlights of my videos, as well as some other posts on entrepreneurship and news of the financial markets. You already know that I have a Discord channel where I put all my trading setups and I keep you guys updated on the price action. It's totally free, so you should definitely check that out. Links will be in the description. But in any case guys, just as usual, I would like to remind you all, stay smart, stay bold, but most important of all, stay cheeky. Take care guys.